Hello, everyone, and welcome back to the GMS Weekly podcast, where we break down the key developments shaping the global ship recycling markets.
It's week 23 of 2026, and this week's headline is simple. Traffic is returning through the Strait of Hormuz, but the recycling window is gone.
Exactly. After 8 weeks of waiting, reports now show that traffic through Hormuz has picked up materially over the past fortnight.
But the formal US-Iran framework is still unsigned.
Correct. The strait seems to be reopening in practice before the paperwork is complete.
So, the market has finally received the reopening signal it was waiting for.
It has, but not in a clean or orderly way. Vessels are moving in coordination with the U.S. military, but traffic is still well below pre-conflict levels.
And the political situation remains fragile.
Very fragile. The tentative framework remains unresolved, with continued disagreement around enriched uranium and control of the strait.
And there were still military incidents this week.
Yes, the conflict spilled into Bahrain and Kuwait, with attacks on U.S. naval bases and commercial vessels. So this is de-escalation, but not normalization.
That distinction matters.
It does. The market is pricing a resolution, but the region has not fully delivered one.
Oil prices seem to reflect that.
Brent crude has eased into the $95 to $97 range, down significantly from the war premium highs earlier in the quarter.
But freight is telling a very different story.
Exactly. The Baltic Dry Index reached above 3,200, and Capesize earnings touched nearly $49,500 per day.
That is the strongest level of the quarter.
It is, and it gives owners a very strong reason to keep older vessels trading.
So even though oil is easing, recycling supply is still not improving.
Correct. The freight market continues to support trading over beaching.
That has really been the story all quarter.
Full demand, cleared financing, firm pricing, and still no meaningful tonnage supply.
Let's move through the recycling destinations, starting with Bangladesh.
Bangladesh remains one of the most stable markets in the basin. The taka held near 122.75 against the dollar.
Still inside the same band it has held throughout the entire war quarter.
Exactly. That currency band has survived the Brent spike to 126, the fall back toward 95, the Indian rupee's sharp volatility, and repeated record lows in the Turkish lira.
That stability has helped Chattogram.
It has. Foreign exchange reserves remain the buffer, and local steel prices held around 66,500 to 66,700 taka per ton.
Around $542 to $543 per ton.
Correct. Bangladesh still has demand, and the letter of credit pipeline remains in its most permissive position since the conflict began.
But now the monsoon has arrived.
That is the operative point. Eid has passed, the working week has resumed, but the pre-monsoon beaching window has effectively closed.
So the constraint has shifted.
Exactly. Earlier, it was geopolitics. Now it is weather. Chattogram still wants ships, but the season has turned.
Moving to India, the rupee continued to recover.
Yes, the Indian rupee improved for a third consecutive week, easing to around 95.35 against the dollar.
Helped by the Reserve Bank of India.
Correct. The RBI held its repo rate at 5.25% and announced measures to attract foreign capital, including changes aimed at overseas investment in government bonds.
So the rupee is in a healthier position than it was 2 weeks ago.
It is, but the recovery remains conditional. The US-Iran deal is still unsigned, and India's exposure to energy flows through Hormuz has not disappeared.
The RBI also adjusted its outlook.
Yes, it raised the inflation forecast and trimmed growth expectations, which shows that energy pressure remains a concern.
What about along steel?
Steel prices firmed in dollar terms, trading around $409 to $414 per ton.
But India remains the lowest-priced subcontinent destination.
Correct. The gap to Pakistan remains around $285 per LDT.
And despite stronger currency and firmer steel, Alang is still waiting.
Exactly. More than 110 yards remain compliant. The rupee has healed, and pricing improved slightly. But the ships did not arrive before the monsoon.
Pakistan continues to be the standout currency story.
It does. The Pakistani rupee firmed to around 278.40 against the dollar, its strongest level of the year.
And still the only subcontinent currency to have appreciated against the dollar through the conflict?
Correct. The state bank's earlier rate hike, disciplined reserve management, and resilient remittance inflows have all supported the currency.
Adani's steel pricing also remains the strongest.
Yes, local steel prices held around 195,000 rupees per ton, or close to $700 per ton.
That keeps Pakistan well above India.
Around $285 per LDT higher. Structurally, Pakistan ends the quarter in the strongest position in the basin.
Stable currency, firm pricing, and improving certification.
Exactly. 3 HKC certified yards remain operational, with more certifications in the pipeline.
But the final result is still the same.
No ships. Pakistan's position is intact, but the tonnage did not arrive.
And finally, Turkey.
Turkey remains the outlier. The lira held near 45.88 against the dollar, close to its recent record low.
So unlike the Indian rupee, the lira did not meaningfully recover on the Hormuz improvement.
Correct. Turkey's pressures are mostly domestic and structural, not primarily Hormuz-driven.
Inflation remains the key issue.
Yes, the central bank's revised end 2026 inflation projection remains well above the earlier target range, while April inflation remains the latest operative reading.
And for ship recycling?
Aliaga remains structurally uncompetitive for mainstream tonnage, with prices around $268 to $290 per LDT.
So Turkey remains focused on EU-regulated tonnage.
Exactly. Compliance, not price, continues to define Turkey's role.
Looking at the broader picture, week 23 closes the quarter with a clear message.
Traffic through Hormuz is returning. Brent has eased, the rupee is healing, Pakistan is steady, Bangladesh is stable.
But none of that changes the key recycling issue.
No, the ships did not arrive before the weather changed.
The traffic returns.
But the window's gone.
That's the story of week 23.
That's all for this week's update on the global ship recycling markets.
We'll be back next week with more insights. If you would like to get the complete market report delivered to your inbox, subscribe to GMS Weekly through GMS website.
Until then, stay safe.
And thank you for listening.